Pioneering approaches, incredible returns, high levels of discipline and consistency. Our top 5 mutual fund investors not only made themselves incredibly wealthy, but also provided substantial returns for those that invested in their funds. Unlike their hedge fund peers, mutual fund managers offer their investment capabilities to the masses through their publicly available funds. We're going to look at 5 of the best, their approaches, and what lessons everyday investors can learn. Our journey begins with Peter Lynch, one of the most successful fund managers in history. Lynch is best known for his exceptional performance at Fidelity Magellan Fund from 1977 to 1990. During his tenure, he achieved an average annual return of nearly 29%, more than double the S&P 500 index over the same time period. To put that into perspective, if he'd invested $10,000 in the fund when it launched, it would be worth over $280,000 by the time Lynch finished managing the Magellan Fund around 14 years later. Lynch believed in a simple yet powerful philosophy: invest in what you know. He encouraged investors to research companies, understand their products, and invest in ones they believed in. His approach was focused on long-term investing and holding on to winning stocks. By following Lynch's approach, many investors enjoyed substantial gains by investing in companies like McDonald's, Ford Motors, and General Electric. Peter Lynch's success proves that with diligence and insight, even individual investors can achieve remarkable returns. The key for Lynch was finding quality companies that were able to continually grow their earnings over the period in which he held them for. The differentiator is that the companies don't have to be little-known names, but rather big, quality companies with the potential to compound their earnings and grow to be even bigger. Now, let's turn our attention to Bill Miller, a mutual fund manager known for his remarkable streak of beating the S&P 500 for 15 consecutive years. Miller has received numerous accolades, including being recognised as the Fund Manager of the Decade by Morningstar and the Greatest Money Manager of the 1990s by Money. Bill Miller's tenure as the manager of the Legg Mason Value Trust Fund made him a household name in the world of investing. His unique investment style and bold decisions set him apart from the crowd. If someone invested $10,000 in the value equity strategy in 1982, it would have been worth $330,000 when he finished in 2005. Bill's approach was to focus on companies that have strong competitive advantages and are trading at a discount to their intrinsic value. He believed that a combination of rigorous analysis and a contrarian mindset led to significant successes. Now let's look at 3 of Miller's best investments and how it contributed to his success. One of Bill Miller's most famous investments was in Amazon. He recognized the potential of the e-commerce giant before it became the global powerhouse it is today. His investment in Amazon played a significant role in his streak of outperforming the S&P 500. During the late 90s and early 2000s, Bill Miller's investment in America Online was well timed. However, it's worth noting that the timing of his exit from the investment before the dot-com bubble burst played a significant role in his streak of outperforming the market. Miller's contrarian approach also led him to invest in Fannie Mae, a government-sponsored enterprise in the housing sector. At the time, Fannie Mae was facing challenges, but Miller saw value in the company and its potential to recover. Miller considered that probably the scarcest resource for any analyst or portfolio manager is insight, the ability to see what others do not. The next Bill on our list is the legendary investor Bill Gross, also known as the Bond King. Bill was co-founder of PIMCO and was a key driver in revolutionizing bond investing through his innovative strategies, including placing strategic bets on interest rates and credit markets. Gross made his name through his tenure managing the PIMCO Total Return Fund, one of the world's largest bond funds. This fund gained recognition for its consistent performance and Gross's ability to navigate the complexities of the bond market. The fund gained prominence for its impressive track record and assets under management often exceeding $200 billion. The PIMCO Total Return Fund outperformed its benchmark index for years under Gross's leadership. His ability to make timely investment decisions and strategically allocate assets contributed to its success. Now let's look at some of the key elements of his success. Bill Gross developed strategies that went beyond conventional fixed income management, such as actively trading in and out of bonds based on macroeconomic trends and shifts in interest rates, which helped deliver returns that outperformed market benchmarks. Gross possessed a deep understanding of macroeconomic trends and their impact on financial markets. His ability to anticipate changes in interest rates, inflation, and overall economic conditions allowed him to position his portfolio and make well-timed investment decisions that capitalize on shifting market dynamics. His conviction in his analysis led him to make bold investment decisions that often differed from the wider market. Gross's deep research and analysis allowed him to identify hidden value in the bond market. His analytical rigor and adaptability gave him a competitive edge. We now turn our attention to John Neff, a legendary mutual fund manager celebrated for his unique contrarian value investing style. John Neff's tenure as the manager of the Vanguard Windsor Fund earned him a reputation as a master of value investing, known for his ability to find hidden gems in the market. Neff ran the Vanguard Windsor Fund from 1964 until his retirement in 1995. During that time, he averaged a 13.7% annual return at the fund, which outperformed the S&P 500 in 23 of those 31 years. Neff grew the fund from $75 million in assets under management to $13.6 billion. Neff's approach was to look for stocks that were undervalued by the market but had potential to deliver strong earnings growth. He considered patience is key, as value often takes time to be recognised. Neff's strategy was characterised by his willingness to invest in out-of-favour sectors and companies, seeking opportunities where others saw challenges. John Neff's strategy of looking beyond short-term market sentiment and focusing on a company's intrinsic value was ahead of its time. His ability to identify potential value before it became mainstream set him apart from his peers. Neff's track record is marked by his contrarian bets on companies that eventually experienced significant growth. He believed in digging deeper, uncovering value that might not be immediately apparent. John Neff's legacy teaches the importance of patience, independent thinking, and the potential rewards of going against the grain. The last pioneer on our list is T. Rowe Price Jr., a trailblazer in the field of active investment management, who gained the title the father of growth investing. T. Rowe Price Jr. was the founder of T. Rowe Price Associates, a company which still bears his name today. T. Rowe Price Group is now one of the largest financial services firms in the world. In 1950, Price set up the T. Rowe Price Growth Stock Fund, the first mutual fund to be offered by his firm. This flagship fund averaged 15% growth annually for 22 years. Price is best known for defining and promoting the concept of growth stocks. He believed that investors could earn superior returns by investing in well-managed companies whose earnings and dividends could be expected to grow faster than inflation and the overall economy. The core of Price's approach was the use of proprietary research to guide investment selection and diversification to reduce risk. He also pioneered the approach of charging a fee based on the assets under management in a fund, rather than charging a commission. This approach binds the success of the investment firm to the success of the portfolio and the stocks it invests into. Throughout his career, T. Rowe Price had an uncanny ability to identify companies with strong growth prospects, and his long-term approach emphasized riding out cyclical ups and downs in the stock market to deliver significant returns for his clients. T. Rowe Price Jr. was a true visionary in the investment world. His emphasis on research, discipline, and long-term perspective laid the foundations for active fund management as we know it today. And that concludes our rundown. If you like this video, please like and subscribe. Thank you for watching.